Diane King Hall, host of Morning Movers, is with me as we are talking about some of the big movers. I mentioned on the S&P 500, Centene being a big laggard, and Diane will tell us why.
Shares are dropping precipitously, as you mentioned, Nicole, for Centene. The company yanking its guidance for the year. It's obviously not the first in the healthcare space to do that this year. You'll recall earlier this year, United Health did the same thing. There are a couple factors that's really driving the issue here. Deteriorating conditions in the government subsidized health insurance markets. We're talking about the Affordable Care Act marketplace. And then, of course, also enrollees, they're saying, are sicker than anticipated. So that increases the cost burden when you think about the plans that they service, such as Medicaid plans. They're anticipating a $1.8 billion hit to earnings. That would translate to $2.75 per share. Again, that's because of these worse than expected member health and cost trends. In Medicaid, Centene seeing rising costs in behavioral health, home health, and specialty drugs, especially in high-cost states like New York, like Florida. And then they flagged insufficient rate adjustments added to service in those areas. So that's a key issue there. And then growth in the exchanges, in the Affordable Care Act exchanges, it's been slower than expected across nearly 24 states. Again, this points to an industry-wide struggle that we've been seeing across the healthcare space. United Health had talked about soaring costs it's faced. Humana has been facing soaring costs, especially in Medicare Advantage. As we know, CVS exiting the Affordable Care Act marketplace altogether by 2026. That impacts some 1 million members. So there's a challenge across the space. And you can't forget about the policy and just the political backdrop here. The big, beautiful bill that's been making its way through Congress, that could slash billions of dollars in funding for Medicaid and the Affordable Care Act marketplace. So that will hit Centene.
Yeah, I was thinking about that. I was thinking about that bill, and you know, this is really for the underinsured, right? Medicare, Medicaid. You just summed it all up beautifully, and you know, it just looks like the bill is not going to necessarily be in favor of a name. And if you continue to follow the healthcare sector, select Spider, XLV, you could look at IBB, but Centene also, as you noted, withdrawing the outlook, really, that just provides the question of what's next, you know, and Wall Street doesn't like that uncertainty.
Absolutely. You nailed it. There's no clarity there in terms of how analysts are seeing it. UBS now downgrading Centene to a neutral from a buy. Their price target now 45. That's a sharp drop. It still signals some, you know, potential reclaiming of some of the losses that we're seeing today, but that's down all the way down from $80 a share was their previous price target. JPMorgan Chase downgrading Centene to neutral from overweight. Their new price target now $48 a share. That's all the way down from 75. B of A, though, they are maintaining their neutral view on Centene, but they have also lowered their price target, Nicole.
Yeah, understood. Yeah, as you look through this, as you noted, you know, you look at all the different 22 of the company's 29 health exchange market states. Just not seeing the market growth that they need. Let's turn our attention over to the banks, because after that Fed stress test, that was pretty good news for the most part.
It was. And, you know, we're talking about health in one respect. This is a health check when it comes to the banks, the stress test, which they have done this annually for years now, ever since the GFC, the Great Financial Crisis. So the banks did well overall. And so as a result, you have banking giants increasing their dividends or announcing plans to increase their dividends after clearing this annual health check by the Federal Reserve. Lenders were shown they have enough capital to sustain scenarios, whether we're talking about severe economic downturn, high unemployment, market turmoil as well. So they're going to return some capital to shareholders via both dividends and buybacks. All 5 banks increasing their quarterly dividends rather. JPMorgan Chase, Morgan Stanley, Goldman Sachs, Bank of America, Wells Fargo for Q3 2025. JPMorgan, Morgan Stanley, and Wells Fargo announcing also share repurchase plans. JPMorgan Chase leading the pack. No surprise there. They've got the fortress balance sheet, a lot of cash to deploy, $50 billion. That, of course, signals confidence in their, not just their financial position now, but the future path and just that desire to reward shareholders. In terms of the regulatory landscape, JPMorgan Chase did highlight some pending regulatory changes, so there's a little bit of uncertainty there to capital requirement rules, and so that signals some headwinds there. Now, some of this has said this, that the size and timing of the repurchases will depend on market and regulatory factors overall. So it's a cautious approach, but optimistic, clearly, with the fact that they're going to reward shareholders.
And look, people love dividends and buybacks. They feel like things are good, and you're seeing these names at record highs, Goldman and JPMorgan. I mean, it's just sort of like, oh, we're the roaring 20s back. People are excited, and they love to see this group do well, particularly when you have more mergers and acquisitions and IPOs. That I know we're a little late with that, but there were hopes that this administration would be more business friendly and we'd see more of that, and I'm still hearing that will occur.
Yes, and it has been picking up, right? In the back half of this year is expected to see more activity there on both the M&A and the IPO front. So these moves by the bank certainly signals just a sign of strength and resilience within the financials. And you have to keep in mind, obviously, that JPMorgan Chase has been an outperformer compared to the S&P 500 year to date. Bank of America also outperforming the S&P 500, not as significantly as JPMorgan Chase. That stock up more than 20%. Wells Fargo also outperforming the S&P 500 year to date. So it goes back to the theme that I know you and I, Nicole, have heard early this year, where there was this expectation of outperformance in the financials. Yes, there was some bumpiness in the spring as a result of tariff policy, but we've gotten some clarity since then. So the road forward does look strong when it comes to the banks, and you can see that playing it out that way, especially to your point about, they have confidence when they're announcing the dividends, the buybacks.
Look, I mean, the $100 billion parade is what the headlines are saying. I mean, that feels very catchy. It's talking about the payout parade of all these banks that you just mentioned, JPMorgan, Morgan Stanley, Goldman. You went over them. JPMorgan's 7% hike in the dividend. So between the dividends and the buybacks, they're calling it the $100 billion payout parade. All right, Constellation Brands had its numbers last night. Thoughts there?
They did miss expectations, but it's not being dinged right now. It was bouncy in the pre-market, bouncing around. The shares were lower, then they were higher. It looks like investors are focused more on the optimistic point of view that they kind of stood by their guidance. But look, they missed expectations on both the top and bottom line. Adjusted EPS came in at $3.22 a share. That was weaker than expected. Revenue $2.52 billion. That was also weaker than expected. Street was looking for $2.55 billion. They have tariff pressure, tariffs on aluminum and canned beer imports that hurts profitability. It's sliced into margins for them. It's essentially taking the toll. We know that the aluminum tariffs increased 25% in March, 50% in June. So that's a direct impact to Constellation's core business. Their core beer products, those rely heavily on imported aluminum cans. So that's a headwind for them. And it's essentially crucial to its business. We think of Corona, Modelo, et cetera. That drives 80% of revenue for Constellation Brands. There's also been some soft demand when it comes to consumers. A big part of their consumer base is Hispanic consumers, and there's been some hesitation there because of the just overall immigration policy. So there's been some pullback within demand there. The CEOs talked about that. In terms of the reaction today in shares are actually higher. They reaffirmed their fiscal 2026 outlook, Nicole. Full year guidance, they're projecting EPS to come in between $12.60 to $12.90. Sales growth, they're expecting that to be down 2% to up 1%. So that's a range where, there could still be some troubles there to some positivity there. And to be fair, we might see shares moving a little bit higher because they've been significantly sold off before now.
Yeah, and Roth analysts noting just July 4th that they're well positioned heading in. Maybe this is a green shoot.
Yeah.
And they even gave me the forecast. Heading into July 4th, the holiday is on a Friday. It's shifted to a Friday, also bodes well. They have more shelf space, and the weather looks favorable. So, and last but not least, the company is facing easier year-over-year comparisons. So a lot of headwinds with aluminum, immigration, people drinking less in this generation, like you noted, all those things. But at the same time, maybe July 4th
will be.
You may have a drink. I don't know.
Some fireworks.
We'll see. Thank you.
Yes,
Thank you,
indeed.
Diane King Hall.
You got
can
it.
catch her on Morning Movers here on Schwab Network.